Sands. Let's bring in our overtime panel now. Joining us now is Morgan Stanley's Caterina Simonetti and CIC Wealth's Malcolm Etheridge. It's great to have you both with us. Malcolm, to you first. We've had some pretty important results thus far in earnings season. What do you think about them and this rally?
Yeah, Scott, so I'm actually happy to see this because I went on the record probably a month ago on your show saying that I expected that we'd probably stay in this trading range of somewhere between 3,800 and 4,000 on the S&P until we got all the way through earnings season and actually got a little bit of a direction from the market. And with earnings reports so far being pretty mixed, maybe a little bit downbeat, I think it does perfectly bode well for where we currently sit. I think maybe the reason we've seen a little bit of a rally in the last couple of trading days, I guess since Friday, is because maybe we're getting to a point of peak bad news where investors are feeling like, all right, at this point, at least in the short term, I know all of the bad news that's out there and I can kind of make educated decisions here. So I'll be interested to see once we get to the end of July, early August, when Q2 earnings season is done, what direction the market ultimately goes. But I suspect that with mixed earnings like we've been having, we're going to hang out in this trading range for a little bit.
Caterina, have you seen enough here to suggest that stocks can have a little more traction here than maybe we otherwise thought?
Scott, without a doubt, we will take any rally we can get. But is this something for us to get excited about? Are we telling investors that this is the bottom and, they should be buying in on this type of dips? Not yet. Investors have a lot to be concerned about. We're dealing with a recession possibility and the debates on whether this is something that might happen. We're dealing with the inflation that is at historic highs. And of course, the biggest issue of them all are the earnings revisions as they continue to come, through the end of the year. So we're expecting a lot of volatility. And this is a challenging time. This is definitely a chopping market. And as nice as these bear market rallies are, we caution investors to stay away from growth and focus on defensive plays, focus on areas that have done really well in this inflationary environment. The spaces like healthcare, like utilities, like REITs, consumer staples, defensive sectors have done well and will continue to do relatively to growth and continue to deliver value and deliver income, which is extremely important here. So
Malcolm, you referenced one of your prior appearances with me here, one in which I do recall you calling out Tom Lee to his face the last time you were on, suggesting he was too bullish, and I want to bring it to you and say maybe you're too bearish. I've got a kickoff to earnings season that frankly doesn't look nearly as bad as some thought. Maybe the consumer's holding up better than a lot of people thought. Maybe the story needs a few more positives within it.
That is fair criticism, and I will take that one. The thing that I would point to, though, as far as making the decision through the remainder of this year of what direction we expect the market to go, we're going to live and die by CPI, I would assume, right? And CPI is a third of it is driven by housing. And so since rents continue to increase and also mortgage rates have increased significantly since I think it was the March lows, the lows earlier this year, I just don't expect that CPI is going to come down in a meaningful way, especially with home builder sentiment. We're getting, reports now that home builder sentiment is at its all-time lows since they started recording it. And so that doesn't really bode well for folks who want to purchase but are currently renting, being able to get out of rentals, which ultimately would bring down those rent numbers and also help CPI in a meaningful way. And so until we fix that problem, the housing supply problem, I just don't really see where I can be wildly optimistic or wildly bullish about, even the intermediate term outlook for the market as far as getting out of this place where the Fed is having to intervene and raise rates to kind of cool things off for us.
In other words, and lastly, Caterina, Malcolm doesn't think the risk reward has gotten any better. Do you?
Scott, I agree with Malcolm. Risk reward is not really any better. There is a lot of risk that still remains in this market. There is a lot of volatility that investors will have to deal with. Now, if they look longer term, 3 to 5 years, of course, there is going to be a recovery eventually in this market. But Federal Reserve right now is focused on curbing the inflation, raising rates. Inflation is still high. It's a concern, but earnings is definitely something that we need to watch. And once we see this positive earnings, once we see that momentum that is all across the sectors, then we can positively say that we are finally getting through this bear market, but not yet. At this point, we still have a lot of volatility ahead of us.
All right, we will leave it there. I'll talk to both of you soon. Katerina and Malcolm, thank you so much.